Welcome to class, everyone. I am your lecturer, and today we're diving into the wonderful and highly testable world of payables. If you're a diploma student currently navigating the FAR210 syllabus, you are in the exact right place. We're going to treat this explainer just like our actual virtual classroom, taking things step by step.
Seeing someone carrying a massive, heavy bag of debt, I know looking at liabilities in accounting can sometimes feel just as overwhelming. It's a lot to carry, but honestly, I promise you, by the end of this session, you're going to be handling these concepts with absolute ease. We'll break down those complex MFRS standards into nice bite-sized pieces.
Let's take a quick look at our roadmap for today. We're covering four main things: defining financial liabilities, comparing trade versus other payables, tackling the MFRS 9 recognition rules, and finally, getting into measurement and journal entries.
All right, let's jump right into Section 1, defining financial liabilities under the MFRS 132 standard.
We have to start with the absolute foundation. Under MFRS 132, a financial liability is defined as a contractual obligation to deliver cash or another financial asset to another entity. So the key phrase you really need to underline here is contractual obligation to deliver cash. If you owe someone money because of a legally binding contract, boom, you've got a financial liability. It's that straightforward. You made a promise, a contract is there, and cash has to leave your hands.
Now pay close attention, class, because here is a classic exam trap that catches students literally every single semester. Look at true financial liabilities first. Things like trade payables, term loans, bonds. Why are they financial? Because you owe cash. But compare those to warranty obligations, deferred taxes, or unearned revenue. Those are non-financial liabilities. Why? Well, with a warranty, you owe your customer goods or repair services. You don't actually owe them cash. So always ask yourself, am I paying this debt with cash or with a service?
So, let's lock in our first mini summary. Always look for that contractual obligation to pay cash when you're identifying a financial liability. And remember the exam trick. Warranties are an obligation for services, not cash. Keep that right in your back pocket for your next quiz.
Moving right along to Section 2, trade versus other payables, and knowing the difference between the two.
Now that we know what a financial liability actually is, let's look at the specific types of short-term debts you're going to handle daily in business. Broadly speaking, payables are just debts owed to a reporting entity's suppliers or vendors. They pop up directly from purchasing goods and services on credit, just in the ordinary, day-to-day course of running a business. Usually these are short-term, meaning you've got to pay them back within a short 30 to 90-day window. But we do need to separate these into two distinct buckets: trade payables and other payables. The main difference is actually super simple. Trade payables are strictly for your core business purchases, like buying inventory from your suppliers on credit. On the flip side, other payables, which are often called accruals, cover your incurred operational expenses that you haven't paid yet. Think of things like your unpaid electric bill, pending employee bonuses, or wages.
Now, you might be wondering, why do we care so much about perfectly tracking all of this? Well, it's not just about passing your FAR210 final exam. In the real world, providing accurate info on payables is absolutely crucial. It proves to the market that a business can actually settle its debts. That attracts more suppliers who trust you enough to offer credit. Plus, it allows the business to monitor payments effectively so you don't accidentally end up with a mountain of long overdue debt.
So your big takeaway for Section 2 is this. Whether it's a trade payable for goods or an other payable for an electric bill, both are short-term financial liabilities generated from simply running your business operations.
All right, Section 3, recognition rules under MFRS 9. Basically, when does it actually count?
Okay, class, take a deep breath because we're looking at exactly when we officially record this debt in our accounting books. The golden rule of MFRS 9 is that a financial liability is recognized when and only when the entity becomes a party to the contractual provision of the instrument. What does that actually mean in plain English? It means you only record the debt when the performance obligation has been met. You don't record it just because you thought about buying something, or even just because you placed an order.
Let's test this with a quick scenario to make sure it really sticks. Imagine Gaga BHD orders a massive 20,000 ringgit smart TV from a supplier named Reka BHD on credit. At what exact moment does that debt become real to an accountant? Let's check the timeline. Here's the sequence of events. On July 2nd, the order is placed. Then, on July 4th, the supplier ships the TV. Finally, on July 8th, Gaga BHD officially receives the smart TV along with the invoice at their office. So,
When do we actually open our books and write down the liability?
The answer is July 8th. We delay recognition until July 8th because two very important criteria are finally met on that exact day. Number one, the transaction becomes relevant. The performance obligation is fulfilled because Gaga BHD actually received the TV, which triggers the contractual obligation to pay. And number two, we have faithful representation. That 20,000 ringgit amount is now 100% certain and officially evidenced by the invoice that arrived with the goods.
To summarize our third section, never, ever fall for the trick of recording a payable on the order date. An order is just a commitment. You always have to wait for the delivery and receipt of the goods to prove the performance obligation is actually met. And finally, Section 4, Measurement and Journal Entries. It's time to write it down. You guys are doing fantastic so far. Now let's translate all these theoretical MFRS rules into the actual numbers and journal entries you'll be writing in your exam booklets. Once we know when to recognize the payable, we need to know how much to record it for. This is what we call initial measurement.
The standard states that a financial liability is initially measured at its fair value plus any transaction costs directly attributable to it. But here's some really good news for your diploma-level questions. Practically speaking, this fair value on initial recognition is normally just the transaction price. It's simply the agreed-upon amount listed right there on the supplier's invoice.
And this perfectly illustrates the basic accounting mechanic you're going to use. To recognize the purchase when incurred, you debit your purchases account to show the expense of what you received, and you credit accounts payable to show the liability of what you now owe. Let's apply this to our Gaga BHD scenario from earlier. Here's exactly how your final answer should look on a test. Using the correct recognition date of July 8th, you debit purchases for 20,000 ringgit. Then, you credit accounts payable for 20,000 ringgit. Notice how I added -Reka BHD to the credit line? Always specify the supplier's name to show exactly who you owe the money to. So, let's lock these final steps into your memory. Measure out the transaction price, use the date you actually received the goods, debit purchases, and credit accounts payable. And please, remember my little trick of explicitly naming your supplier in the credit line. Lecturers love seeing that, and it is a surefire way to ensure you get full marks. You've done a really fantastic job today. You now know exactly how to define, recognize, and build a payable perfectly. But I'm going to leave you with a final provocative thought to ponder before our next class. We know how to put the debt on our books, right? But what exactly are the derecognition rules when we finally hand over the cash and pay that debt off? Think about how that settlement is going to alter our financial statements, and we will pick up right there next time. Keep studying, and I'll see you in the next explainer.